Welcome to The Deep Dive. We're the show that, digs into the key info you need, gets you informed fast. Today, it's all about something that affects literally everyone, money, and specifically how to build wealth. Now, this area is just packed with advice. Some sounds great, some really makes you think, but honestly, a lot of it just seems to clash. You've probably felt like you're just wading through it all, trying to figure out, okay, what's really going to work for me? So our mission today is pretty clear. We're going to unpack some big financial ideas you hear about all the time. We'll dive into some really practical strategies for actually building wealth. And then we'll zoom out a bit, look at the psychology behind it, all the mindset stuff that can often be the real decider between success and, well, not. Think of this as your map through the wealth building landscape.
And we've gathered a really diverse set of sources for you. We're pulling from all over. There's a quite revealing YouTube interview with Robert Kiyosaki, the rich dad guy, always stirs things up. Then we've got Forbes articles looking at side hustles, some really grounded advice from credit unions, detailed investment guides, academic stuff on financial literacy, and even a pretty lively Reddit thread that pushes back on some of these ideas. So yeah, you're not just getting one angle. This is a genuine deep dive.
Okay, let's start with him then. Robert Kiyosaki, author of Rich Dad, Poor Dad, which, everyone's heard of it. His core belief, the absolute foundation, is pretty radical, he says. Never work for money itself. Not the rupee, peso, yen, yuan, dollar, whatever. Work to get assets. That's his mantra.
Right. And he often tells that story about growing up in Hawaii, doesn't he? Seeing the difference between his own dad, his poor dad, who was highly educated, had a good government job, salary, all that, and his friend's dad, the rich dad, who was an entrepreneur. And the lesson he says he learned was, if I pay you, you think like an employee. It basically shaped his whole outlook on traditional jobs versus building wealth.
Yeah, the idea that school trains you to be an employee, not an owner or investor.
Exactly. And he breaks that down with his cash flow quadrant. Remember that? ESBIE for employee, S for self-employed or specialist. Think doctors, lawyers, small shop owners where they are the system. Then B for business owner, where you own a system that makes money without you necessarily being there every day. Mm-hmm. And finally, IS for investor, where your money is working for you.
Yeah.
His whole point is you want to move towards B and I for real financial freedom.
Because in E and S, if you stop working,
your income stops, pretty much.
Right.
In B and I, the assets of the system keeps generating income. That's the key difference he highlights.
That alone is a big mental shift for most people. But then he gets into debt and taxes, and it gets even wilder. Most of us are taught debt is bad, avoid it. His poor dad certainly thought so.
Mm-hmm. Standard advice.
But his rich dad encouraged using debt. Kiyosaki himself says he uses debt, like in Monopoly, right? Trading greenhouses for red hotels often needs leverage.
Yeah, he uses that analogy a lot, and he applies it directly to real estate. He says he bought those thousands of rental properties using debt, not his own cash, primarily.
Okay, and taxes. This is where it gets really controversial. He flat out claims capitalists don't pay taxes legally. He points to people like Trump saying they just use the tax code, the breaks that are already there.
Right. He frames it as understanding the rules of the game for the B and I quadrants. Mm-hmm. Not tax evasion, but strategic minimization using legal means.
So when he says I don't pay taxes, he means he uses corporations, depreciation, things like that, to legally reduce his tax bill to zero or near zero.
And to really get that, you have to understand his definitions of assets and liabilities. They're different. For Kiyosaki, it's simple. An asset puts money in your pocket. A liability takes money out of your pocket, period.
So your own house.
For most people. He calls it a liability.
Yeah.
Because you're paying the mortgage, the taxes, the upkeep. It's costing you money each month. It's not generating income.
Unlike his rental properties.
Exactly. He sees those 15,000 rental units, or however many he claims now, as assets because they generate monthly cash flow. It's a very specific cash flow focused view.
Okay, so that's the personal finance angle, but he also connects this to a bigger global economic picture, right?
Well, absolutely. He has a very distinct macroeconomic outlook. He talks about this sort of global battle.
Yeah.
He pits the East, mainly the BRICS nations, Brazil, Russia, India, China, South Africa against the West, primarily America and Europe, using the dollar.
And he's predicting trouble.
Big trouble. He's been predicting a U.S. dollar collapse for years, especially if China pegs the yuan to gold. He talks hyperinflation, even potential war. He thinks America's heading into a depression right now.
Wow. Okay, so given that rather gloomy outlook, how does he say he invests his own money?
He focuses on what he calls real money, tangible things. He invests heavily in gold and silver. He doesn't just buy ETFs. He says he owns actual gold and silver mines, like the Trixie mine, OCDC on the NYSE. He mentions that one.
Okay, physical assets. What about crypto?
He's in it. Says he bought 60 Bitcoin back when they were around $6,000 each. So quite a return there. But he's also cautious now. He worries about government crackdowns, regulations, and particularly central bank digital currencies, CBDCs. He thinks they could undermine or heavily control existing cryptos.
So his hierarchy is sort of gold is God's money, Bitcoin is people's money, and the dollar is
fake money, toilet paper. Those are his terms. Very blunt.
It's definitely a provocative stance all around.
It really is.
Okay.
Which naturally brings us to the other side of the coin. These ideals, while super popular, are heavily debated. You find a lot of critics who argue his advice is often just too vague, sort of high-level self-help boilerplate, without the specific how-to.
Right, more motivational than instructional sometimes.
Exactly, and some critics suggest his own wealth came more from the books and seminars, the Rich Dad brand itself, rather than, purely from brilliant investing.
And there have been some more serious issues raised too, haven't there?
Yes. There have been accusations floating around for years, people calling him a scammer. There have been lawsuits related to past businesses, fraud allegations, even bankruptcy filings for some companies he was associated with.
And the Rich Dad story itself.
Some critics question if Rich Dad was even a real person, or more of a composite character, a narrative device. Kiyosaki insists he was real, but keeps his identity private. Plus, his promotion of multi-level marketing, MLMs, that draws fire. And there have been allegations about pushing questionable tax strategies or maybe using company funds inappropriately for personal things. It's a real mix of opinions out there, which really underlines the need for you listening to think critically. Don't just accept any single source, no matter how popular.
Okay, so clearly a very polarizing figure, lots of debate, strong opinions both ways. But you can't deny his impact, can you? For millions of people, that book was the thing that made them start thinking differently about money.
That's true. The asset versus liability distinction, even if you use a more standard definition, that concept has shifted perspectives for many. It got people talking.
If some of the other advice is maybe outdated now or seen as, potentially toxic by some critics.
Right.
So for someone trying to build a solid foundation today, moving beyond the controversy, where do we go? What's the reliable starting point?
That's the perfect transition. We move to the bedrock. Financial literacy. Think of it like the operating system for your money. It's having the knowledge about budgeting, saving, investing to make informed choices.
Makes sense.
It's absolutely crucial for actually accumulating wealth, managing your money day to day, and feeling secure about the long term. Now let's break down those core parts. First, budgeting. We all know we should do it right.
Yeah, but actually sticking to it, that's another story.
Exactly. It's not just listing income and expenses. It's really understanding your needs versus your wants. And, deeper still, aligning your spending with your actual values, what's truly important to you. A good budget gives every dollar a job and adapts as your life changes.
Okay.
Then saving.
Consistency is king here. We hear about compound interest, your money making money, but it only works if you save consistently. And the best trick, pay yourself first. Treat your savings like your most important bill. Set up an automatic transfer right after payday.
Out of sight, out of mind. Pretty much. Before you even have a chance to spend it, then investing. This scares a lot of people. They think it's like gambling.
Yeah, the stock market seems unpredictable.
It can be short term. But smart investing isn't about timing the market. It's about diversification, spreading your money across different things like stocks, bonds, mutual funds, ETFs. It's about understanding your own tolerance for risk and knowing how things like inflation affect your money over years, even decades.
Right. And what about the flip side, debt management?
Crucial. Know your interest rates, know the loan terms, the big one. Attack high-interest debt first. Credit cards, usually. Also, steer clear of predatory lenders. And learn to use credit wisely, build a good history, don't use it just to live beyond your means.
Okay, that makes sense. What else is part of this literacy package?
Risk protection. This is about shielding yourself from the unexpected. Things like having the right insurance, health, car, home, life insurance if you have dependents, building that emergency fund, aiming for, say, 3 to 6 months of essential living expenses, and maybe some strategies to hedge against big market downturns, depending on your situation.
And the last piece.
Long-term planning. Setting clear, realistic goals. Retirement, buying a house, kids' education, whatever it is for you. And then this is key, breaking those big goals down into smaller, actionable steps. It gives you a roadmap, makes it feel achievable.
That's a great framework. But, for a lot of folks, the immediate hurdle is just escaping that paycheck to paycheck grind. It feels impossible to save or plan when you're just trying to make it to the next payday.
It's a really common and tough situation.
Yeah.
But there are definite strategies that work, even if you start incredibly small.
Okay, like what?
Well, first, we already mentioned it, but it bears repeating. Pay yourself first. Seriously, non-negotiable. It's less about willpower and more about setting up a system. Automate it.
Yeah.
Even if it's literally $5 or $10 a paycheck into a separate account you don't touch.
Just start the habit.
Exactly. Start the habit, build the muscle. Then when you can, increase it. Got a raise. Save half of it automatically before you get used to spending it. Consistency builds momentum.
Okay, number 1, pay yourself first. What's 2?
Number 2, track your spending. You absolutely have to know where the money is going. Use an app, a spreadsheet, even an old notebook. Just track it for a month. You'll likely be surprised.
See where the leaks are.
Precisely. Maybe it's lunches out. Maybe subscriptions you forgot about. Maybe your insurance could be cheaper if you raised the deductible slightly. Find areas to trim consciously. Not about misery, just intention.
Got it. Track it to manage it. And third,
create a personalized plan. Generic budgets don't always stick because they're not yours. Your budget needs to reflect your life, your goals. Maybe travel is huge for you, so you cut back elsewhere. Maybe owning a home is the priority.
tailor it.
Yes. Make a plan you can actually live with. One that includes saving for goals and for unexpected stuff so you're not constantly caught off guard. Build in some buffer.
Okay, so foundation built, paycheck cycle hopefully broken. What about actually growing that money through investing? You mentioned a portfolio.
Right. Strategic investing, we can think about it in roughly 4 steps to building a profitable portfolio. Step 1, determine your asset allocation. This is the big picture. How much goes into stocks, bonds, real estate, maybe alternatives? It depends heavily on your age, how much money you have, when you'll need it, and crucially, how comfortable you are with risk.
So younger person, maybe more in stocks, older person, more bonds.
Generally, yes. Longer time horizon means you can ride out market volatility, so maybe more growth-focused equities.
Yeah.
Closer to retirement, you typically want more stability, so bonds might play a bigger role, but it's personal.
Okay, step 1, decide the mix. Step 2.
Step 2, achieving the portfolio. This is the how. How do you actually buy those assets? You could pick individual stocks and bonds if you have the time and expertise, or for most people, using mutual funds or ETFs, exchange-traded funds, is much simpler. They give you instant diversification across many holdings.
Easier to get started.
Much easier and generally less risky than picking individual winners.
Right. Step 3.
Step 3, reassessing weightings. Your portfolio won't stay perfectly balanced on its own. Markets move, maybe your stocks did really well, and now they're a bigger percentage of your portfolio than you initially planned.
So you need to check in periodically.
Exactly. Maybe once or twice a year. See if things have drifted significantly.
Yeah.
Also, your own life changes. Maybe your risk tolerance changes or your goals shift. Your allocation might need tweaking.
Makes sense. And the final step, step 4.
Step 4, rebalancing strategically. If your assets have drifted from your target allocation, you adjust. If stocks are now overweight, you might sell some and buy more bonds to get back to your target mix.
Okay.
But you need to be smart about it. Think about taxes selling winners might trigger capital gains tax. Sometimes it's better to rebalance by directing new contributions towards the underweighted areas.
Ah, clever. Avoid selling if you don't have to.
Right. The goal is just to maintain your desired risk level over time, not necessarily chase returns or time the market perfectly.
This is great practical stuff. But what's really fascinating, I think, is the piece we touched on earlier, the psychology, the mindset. Research seems pretty clear that how you think about money, your relationship with it, might actually be more important than how much you start with.
It's hugely important. People who build sustainable wealth often aren't the highest earners or the ones who got lucky. They've typically mastered certain mental hurdles that keep others stuck.
It's not just about the spreadsheets and the strategies, then.
Not at all. It's about the inner game.
So what are some of those key mental weaknesses that successful people overcome?
Well, based on research and observation, we can pinpoint about 5 common ones. First is the instant gratification trap. Remember that marshmallow test with the kids?
Yeah, wait for a bigger reward later.
Exactly. That ability to delay pleasure is fundamental to saving and investing. Wealth builders see short-term sacrifices, maybe driving an older car, packing lunch, not as deprivation, but as an investment in future freedom. Small choices add up.
Okay, resisting instant gratification. What's number 2?
Number 2 is paralyzing fear of financial risk. People hate losing money. Loss aversion is powerful. It can make people too scared to invest at all.
So they just keep cash, which loses value to inflation.
Precisely. Wealthy individuals learn to distinguish between calculated risk, like a diversified portfolio, and just gambling. They understand that taking zero risk is actually its own kind of risk over the long term.
Right. Number 3.
Number 3, the I'm just not a money person fixed mindset. Believing your ability to handle money is fixed, that you're just inherently bad at it.
Yeah, I hear that a lot.
People who build wealth tend to have a growth mindset. They see financial literacy as a skill you can learn, something you get better at with practice, and frankly, making some mistakes along the way. Setbacks are lessons, not proof of failure.
That's a powerful shift. Okay, number 4.
Number 4, letting emotions drive financial decisions. Fear makes people sell low in a panic. Greed makes them buy high, chasing a hot tip. Overconfidence leads to big mistakes.
Buying meme stocks.
Or just making impulsive decisions without a plan. Wealthy individuals tend to develop emotional discipline. They stick to their system, their rules, rather than reacting to headlines or gut feelings.
Okay, emotional control. And the last one, number 5.
Number 5, scarcity thinking and living paycheck to paycheck. This mindset keeps you focused only on immediate needs and limitations. It's stressful and consumes mental energy.
Hard to think long term when you're worried about next week's bills.
Exactly. An abundance mindset, by contrast, sees possibilities. Wealthy individuals prioritize automating their saving and investing, partly to reduce that mental load, freeing up brain power to think strategically about growth and opportunity.
So automating things actually helps build the right mindset too.
Absolutely. Neuroscience suggests that building these wealth habits is like strengthening a muscle. Deliberate practice helps. Small, automatic behaviors like those auto transfers to savings or investments, they reduce the daily decision fatigue around money. Consistent discipline, powered by these automated systems, makes good financial behavior feel more natural over time. It becomes less about constant effort and more about just how you operate.
Okay, so wrapping this all up, our deep dive today shows that building wealth, it's really a multi-layered thing, isn't it? It involves looking critically at bold advice like Kiyosaki's, taking what works for you, maybe discarding what doesn't, evaluating it carefully, while also getting grounded in the fundamentals of financial literacy, the budgeting, saving, investing basics, then putting practical strategies into action, like paying yourself first, tracking spending.
The concrete steps.
And maybe the most crucial piece, actively cultivating that resilient, growth-oriented, adaptable mindset.
That's it, exactly. And remember, you really do have the power to take control here. By applying these ideas, committing to keep learning. It's not about finding some magic bullet or blindly following one person. It's about figuring out the financial game that fits your life and your goals, learning the rules, and then playing it consistently and well.
So here's a final thought to leave you with. In today's world, with finances getting more complex, global shifts happening, where does true financial independence really lie? Is it purely in stacking up tangible assets like gold or real estate? Or is it more about building that unshakable, adaptable mindset, the kind that can confidently navigate whatever changes come your way? Something to think about. Keep learning.